Who are you? And where are you going? What do you want?
Hello and welcome to People Making Money. I'm your host, Kevin Bemmel, and we're here every Wednesday at 10 a.m. Pacific time to talk about job hunting and building a business and building wealth, all the topics related to finances. So the last few weeks, the economy has been a lot more volatile than it has been of late. And pardon me one moment. I forgot to close my email. and so I've been talking to more people. The people I've been talking to more frequently are, concerned about their investments. They don't know what to do. And so I thought I would spend a little bit of time today and talk about what we can do when we're faced with this kind of market volatility, the kind of economic turbulence that we've been experiencing, kind of figure it out. So I have a few thoughts. This probably will be a shorter show than normal, but that's okay. So if you've been watching the stock market at all, and I typically I read the Wall Street Journal every day, and so I generally speaking know what's happening with the S&P 500, the Dow Jones Industrial Average, and the Nasdaq, and they were up, and then they were down, and they were up, and they were down. They had kind of a long string of ups until yesterday. And had basically recovered much of the ground that they had lost. Yesterday, they were off by, I think, 0.9% for the Dow and the Nasdaq, and I think the S&P 500 was down, as I recall, 0.6%. Actually, here, you know what? I can here. That's right. I forgot. I've got it right. I've got the paper right here. Here we go. So, okay, S&P 500 declining 0.8%. Yeah, and the Dow and the Nasdaq were down 0.9%. So, most of the indexes were down close to 1%. It is a sector. It is stocks and bonds that are much more volatile in terms of their values than, for example, something like real estate. So, if you have a 401k or an IRA, and it's invested primarily in stocks and bonds, so of course that's experiencing a lot more volatility than something like real estate, which the trend line is much longer. We're talking about months and months, if not years. I was also reading an article about office building or commercial property values in Boston. And, despite the, I should say, commercial property assessed values in Boston, that's a different than property values than market values. So the assessed value, despite the fact that office buildings across the country are still suffering from vacancy, unless you're talking about new, highly amenitized office buildings in New York, something like that. But broadly, the office market sector is still suffering from high vacancy. Despite that, assessed values continued to go up in Boston through last year, and now in the first quarter of this year, they dropped by over $1 billion. So you look at a statistic like that and you say, oh no, real estate values are dropping too. Well, those property values have probably been dropping all along, but the assessment process is a lagging indicator. And so, we have to be careful even how we look at real estate values. So unless you're having a property appraised, every month, you're unlikely to know how its value is changing, number one. And number two, a property can experience some rough times. Maybe it gets vandalized, and so now some work has to be done. And then that gets done, and it's remarketed or repositioned in the market. So, the time it takes to do these kinds of things is very different. So, as a result, how value is affected is different as well. So, I would be careful. I would be careful about the the information you're using to assess what's really happening in the marketplace. And uh, I, I always look at the sleep factor, and if reading something is going to cause me to not sleep well, that's not to say I don't read it, but I make sure that if I read it, I also read competing information to get a broader picture of what might be going on. So, as much as, of course, I want you to watch my shows, this is a complex subject, and I would encourage you to the extent that you're concerned about the topic, and or worse, it's keeping you up at night, seek out more information from people whose opinions you trust. Okay, and that may not be your next door neighbor. Okay, I had a situation. A friend of mine came to Los Angeles to visit a couple of weeks ago. He has some money he needs to invest. We've been talking about this for a while now, and because of the volatility in the market, he was reluctant to put it into stocks or bonds, those kind of financial investments. He, like me, his background is real estate, and early on in the discussion about in what he should invest, I said, "Well, why aren't you looking at some kind of real estate investment? I mean, that you can personally analyze the quality of a real estate investment, whereas you're not an expert in stocks and bonds, and so you're reliant on other people's opinions, number one. And number two, they're a much more volatile investment, and that, I think, like me, doesn't really fit your investing profile. So those are the kinds of things I think we need to look at and assess as we make our way through the times as they are right now, and for however long they're going to continue. So I have 5 thoughts on investing with caution, and how you can, as I said a moment ago, navigate what's going on in the economy and the investment world. So, uh, first of all, you may need to revisit your risk tolerance. So, the market has been largely going up almost without stopping since what, 2010 or thereabouts. So, if you're 30 years old or younger, or maybe even 35 years old and younger, you may not have experienced any kind of significant correction in the market. And so this may, or not correction, any kind of significant turbulence and uncertainty in the market. Certainly, the market collapsed as a result of COVID for a short time, but it pretty quickly recovered. So of course that went on, but it was clear that COVID was what was driving that. What's the uncertainty that's driving market volatility right now is different. While there's the speculation about what's going to happen with tariffs and international trade, what's happening with the geopolitical situation, things like the restriction of shipping through the Red Sea and the Suez Canal. It was reported today that the United States and the Houthis have reached an agreement that they're not going to attack shipping that's going through the Suez Canal, but I read the article about it. It's very short on details. Who knows whether such an agreement is actually going to hold up? So there's a lot of uncertainty there. China's economy, they're issuing less and less data, and China is the second largest economy in the world now. So the less we know about what's really going on in China, the more difficult it is to gauge what's going to happen in the world economy overall. So it's these kinds of uncertainties that are causing the environment in which we're living right now. So it's not a singular thing. A lot of people have focused on tariffs. Tariffs are certainly one issue of uncertainty, but there are a number of others. And smart investors look across the economic stage in order to assess what's really going on. So I would say, don't allow yourself to be blinded by one particular issue or one particular view. Keep your eyes open, keep your view as broad as you can, so you can understand, what's or so that you can analyze what's going on and hopefully gain the best understanding. So number one in that is revisit your risk tolerance. So uh, going back to what I was saying a moment ago, for the most part, um, markets have been on an upswing for most of the last 15 years. So risk tolerance to us kind of wasn't really an issue, because there was a sense that, yeah, things are just going to keep growing and growing and growing, right? And that means that a risk tolerance in that climate is different than risk tolerance when there's turbulence and uncertainty. So this is the sleep factor I was just mentioning a minute ago. If you're finding yourself wanting to constantly look at what's going on, you're obsessing on it, so it may be that the uh, things that you're invested in are actually more risky or more volatile than is compatible with your actual risk tolerance. So, this is a good time to think about that. If you have a financial advisor, to talk to your financial advisor about it, because, like I said, it's very easy to have a sanguine attitude toward risk when there's not a lot of risk in investing, or I should say, when there's not a lot of turbulence in investing. But when you have uncertainty and the concurrent unknowns that uncertainty brings, so now you're facing a different kind of risk, and you may assess, wow, you know what, I guess I'm not as risk tolerant as I thought. On the other hand, if you're kind of digging what's going on right now, you like the ups and downs. Maybe you have a higher risk tolerance than you thought. You like the roller coaster ride. I had a business associate like that years ago when I had my real estate company back in the 80s and 90s through the mid 2000s. He loved risky investments. He was always investing in commodities and futures, all that kind of stuff. It's like, I don't have a risk tolerance for that. That's just too high a risk for me. And so I never invested in those kind of things. So revisit your risk tolerance, think about it, assess your well-being beyond your financial well-being. How is what's currently going on in the economy and with investments impacting your ability to sleep, your relationships, your performance in your work or in school, and that will give you some sense of where your real risk tolerance lies. That's number one. Number two, you may want to keep some cash on the sidelines. Okay, so let's say that you have an investment that's maturing, or maybe has recently matured, right? And now you've got the cash sitting there. Okay, and uh, it may be a better decision that for now just hold on to the cash, or put it in a money market, which is a fairly risk-free investment, or a essentially non-volatile investment. And don't push yourself to put it into something else. Don't push yourself to put it into stocks or bonds or crypto or whatever it is you might normally invest in. Leave some cash on the side. Now, do you want to liquidate all your investments and have all that cash not performing? That may be too extreme. You could miss out on opportunities. For if people 3 weeks ago cashed out. They cashed out kind of at the bottom, or maybe 2 weeks ago actually. They cashed out at the bottom, and of course the market came back up. They locked in a loss and missed out on the gain. So you may decide that you're going to take some particularly, I don't know, risky investments that make up just a percentage of your portfolio, or of your overall investment value, and you're going to liquidate those. Or like I said, maybe you have something maybe you had some savings bonds that matured, or maybe you were invested in a loan and the loan paid off, like a private loan. It paid off, those kind of things. And so maybe sit on that cash. Don't turn around and reinvest it immediately. Okay. And that way you can kind of see how things are get a sense of how things are actually going to play out. Now, what I would caution you not to do is play the game of trying to wait, till it hits bottom, and to buy back in. So if you've got cash sitting on the sidelines, the game of trying to precisely time the market is very, very difficult. Even very experienced investors oftentimes don't make the right call as to when to reinvest in the market. Sometimes they do. Okay, if you've ever heard of a fellow by the name of Dick Ziman, he's a real estate investor here in Los Angeles. I knew Dick as an acquaintance, and Dick was able to anticipate the last, before this one, downturn in office in office building values. He sold out beforehand in the kind of mid 2000s, sold out kind of at the top of the market. And then when the recession of 2007, 2008 hit, the value of these buildings dropped tremendously. And he started buying back in at pretty much the bottom of the market, and did extremely well. Now, it's a little bit easier to do that in real estate because the markets don't drop and rise as quickly as they do in the stock market. And which isn't to say that Dick was not brilliant. I think he was. I would love to have this much of his brilliance, but it is timing the markets is easier to do in real estate. Now, I will use an example though that shows real estate isn't necessarily timeable, if you will. So when COVID hit in 2000, I talked to a number of people I knew, friends who were in the real estate business, and pretty much across the board, they were expecting a big drop in real estate values. Never really materialized, and in fact, some sectors increased. So the value of industrial property generally went up because all of a sudden e-commerce became much more popular, and so distributors and sellers needed much more warehouse and distribution space. Apartment buildings values went up as people started moving into their own apartment to get away from living with other people because they were afraid of getting sick or whatever. So rents went up and apartment building values went up. Home values went up, as you're probably aware, right? And the collapse in office building values didn't happen in the short term. It took longer for that to develop. And part of that was due to owners hanging tight. They weren't selling. So even though perhaps their buildings the value of their buildings were dropping because they were losing tenants. They weren't selling them, so those losses weren't actually, or those reductions in value weren't actually showing up in the marketplace. So, someone who sold out buildings in 2020, 2021, they're they probably haven't been able to buy back in at significantly lower prices. Some office building prices have finally started to show up. Drops in values have finally started to show up, and so you see funds like Brookstone and I can't think of the other one, but they're raising billions of dollars to buy distressed properties, but it hasn't been the kind of widespread carnage that was experienced in the sort of mid to late 2000s and other times in my real estate career. So you want think about keeping some cash on the side, but trying to time the market, especially the stock market, probably not a fruitful strategy. Better to dollar cost average, where you invest on a periodic basis in whatever you're investing in. So, if you're investing in mutual funds or ETFs, so rather than dropping $1,000, in say January and not investing any more until the following January, you're probably better off investing $80 or $83 a month, January, February, March, April, etc., because that dollar cost averages your buy-in, and that creates a more stable picture in terms of how that particular investment will perform. So the routine investing is almost always a better way to go than trying to time the market. Okay, number 3, diversify wisely. If you haven't heard you need to diversify your investments, that's unfortunate to say the least. A diversified investment portfolio is always better, because when some investment sectors drop, others tend to go up, even within stocks. So when there's a recession, typically things like stocks in things like foods and other types of essentials tend to perform well, whereas stocks in non-essentials like luxury goods, certainly, cars, especially luxury cars, they don't perform as well. So, things like, paper towels and household supplies, like I said, food, healthcare, those spending in those sectors holds up even when the economic times are not particularly strong, because people have to eat. They still buy paper towels, they still buy toilet paper and Kleenex or facial tissues. They still get sick, so they still have to go to the doctor, they have to go to the hospital, whatever. Those things don't change with economic ups and downs, as opposed to luxury goods like high-end cars, jewelry, expensive clothing. So one of the things the luxury sector has been experiencing over the last couple of years is the sort of middle income, middle class people who got a lot of money from the government during COVID. They were buying luxury goods with that money, and now that money has been exhausted. People's budgets are tighter because of inflation over the last several years, and so luxury retailers have that segment of their buyers has dropped out. So look, very wealthy buyers, economic fluctuations don't have a whole lot of impact on their buying habits. They buy when they want to buy, not because they always have money. But for most of us who are not in that category, right? When we feel economically strong and we want to buy ourselves something particularly nice, so we will. But when we're feeling uncertain about the economy or there's volatility, we're probably less likely to make those kind of purchases. So when you look at diversification, you want to diversify across sectors, across regions, across asset classes. So now I mentioned real estate a little while ago, and you may be thinking, I don't want to own, an apartment building. It's a big headache managing it. I agree, especially in a state like California. I would never own residential income property here in California. The regulations keep getting more and more burdensome. Insurance keeps going up. It's a very, very difficult sector to navigate here. However, you can buy shares in real estate investment trusts. You can invest as a limited partner or an LLC member in a real estate venture. Typically, you don't need as big an investment to be involved with real estate as a REIT or as a partner, because you're joining together with other people in order to be a part owner of real estate. So that can be a good way of diversifying what you do. Okay, diversifying. I'm sorry, across asset classes. You don't necessarily have to become a direct owner of real estate, and that gets back kind of also to revisit your risk tolerance. So directly owning a piece of real estate, perhaps apart from your house, you may just not have the risk tolerance for it. You may also not have the annoyance tolerance for it, right? Tenants calling you up, complaining, or a pipe broke. These kind, that's not a risk tolerance factor. That's more of a do you have the bandwidth to be dealing with those issues, as well as to be dealing with your work and your family, your other relationships. Do you travel frequently? So it may, owning real estate directly may not be compatible with the other aspects of your life, and so then don't, but find another, perhaps consider another way to be invested in real estate that is compatible with your risk tolerance and how the other facets of your life work. Okay. All right, so diversify wisely. That's another thing to look at. Number 4, avoid emotional decisions. So, if you're watching the market, every day as it ticks up, you're watching the Dow throughout the day. Okay, it's you're unless you really love being on that roller coaster, you're really setting yourself up, and you're putting yourself in an emotionally vulnerable position where you just may not be able to take it anymore, and so you end up making a decision based on the emotion of the volatility rather than on what is best for your overall investment portfolio. So I know for myself, I have a small 401k. I check it maybe once a month. I mean, it's not, whether it goes up or down. I mean, it's a 401k. I'm not going to access the money until I retire anyway. So, there's no point in tracking it on a daily basis. So, there's no reason to do that. And in general, the investments I have, they're meant to be long-term investments anyway. So where they're at today is irrelevant because uh, I'm not going to be selling them today. So there's no reason for me to be watching them on a daily basis. And unless you're living off your investments, you're probably in a similar situation to me. So, if you're investing in order to augment your income and maybe, retire completely, if that's a goal for you. I know for me it's not, but, when I get a little bit older than I am now, perhaps I'll be able to maybe slow down a little bit, right? But I plan to keep on working because I want to feel useful. I think it's healthy to be engaged in productive activity. But having said that, it would be nice to have some investments to fall back on. So I'm not having to every day be concentrated on making sure, I can make ends meet and all that kind of stuff. So, uh, um, constantly tracking your investments and putting yourself on an emotional roller coaster really encourages making bad decisions, because they're being made by emotion, not by uh, what you're seeing in the market and what appears to be taking prudent steps because of the likelihood of the performance of a particular investment. So this also has to do with your risk tolerance. That's why I mentioned that first. So if you are just very, very nervous about investments and how their value changes, so then you probably, or it may be not probably, but it may be a good idea not to put yourself in investments that have a high volatility over a short period of time. Get into things that are more stable, and then you don't have to worry about checking them multiple times a day. You can just let them work. So, um, you know, and the other thing is, you may be invested in something, and because times are volatile and you're watching, and then all of a sudden you see some investment, and it's a stock and its value just drops, and you're like, oh no, what am I going to do, right? Make sure you find out, why did it drop? Okay, something could have happened. um, it reported poor quarterly earnings or something, and because of all the other volatility, a bunch of people sold it, but the market was oversold. And so if you just hang on until the next day or a couple of days, it ticks back up again. So just because the value of a particular investment plunges, that doesn't mean it's going to stay down. People panic, okay, and they sell when they probably shouldn't, right? And that can cause a larger decline than is warranted by the fundamentals of that particular investment. So before you make any decision, really think it through, and as best you can, understand, why is the investment performing the way it's investing, and is this really the right time to sell? Well, likewise, if you're thinking about buying something, is this the right time to buy? So if you've got some cash sitting on the sidelines and you're kind of itchy because you want it in the market, uh, if you're considering a particular investment, is this the right time to buy it? If you're considering an investment that is highly vulnerable to tariffs, so this may not be quite the right time to be making that investment. Maybe a little more fog needs to clear before you would actually put your money in that. Okay. Um, there's still a lot of talk going on, and we don't know what's going to be happening. And so, again, if you've got it in a money market and maybe you're making 2, 3, 4%, something like that, maybe that's okay right now. And rather than making an emotional decision or getting someone hyping you up on buying a particular investment, oh, this is going to be great, it's perfect in a volatile market. I mean, maybe it is, but really look at why they're saying that. Question them, why is this such a great investment despite the volatility in the market? Does it make sense to you? And here's really the bottom line. Investing is largely common sense. Okay. It's about things like supply and demand. It's about things like, when people have money, they buy; when they don't have money, they don't, right? We can largely understand why investments work the way that they work. Okay. It, it, yes, there's all kinds of fancy and analytical techniques and all of that, discounted cash flow and internal rates of return. And I can throw out lots of fancy terminology for real estate. But the bottom line in investing in real estate is, if it's rental property, do people want to rent this kind of property? If it's office building, these days the answer is largely no. If it's apartment buildings in many areas of the country, the answer is yes. But in the Southwest, Apartment markets are overbuilt. So there's more apartments available for rent than there are people who want to rent them. Hence, rents are dropping. And if rents are dropping, what would you imagine is happening with values? They're dropping as well, right? Very common sense. So really engage your common sense as you look at making investment decisions rather than letting yourself get overwhelmed by the emotion of the decision. Okay, so that's number 4. Number 5, focus on quality. Okay, focus on quality. So I mentioned this friend of mine who had some money he wanted to invest, and like I said, he was thinking about some kind of stock thing or some kind of mutual fund or whatever. And I introduced him to a friend of mine who he and his partner have been putting together private real estate investments for, gosh, I think it's 15 years now, 15, maybe close to 20 years now. And they've done very well. Have they, lit the world on fire the way Dick Simon did? No, but most people don't. Most people don't. What they've done is year after year, they've delivered solid results for their investors, right? They do quality real estate investments. They deeply research the markets in which they consider investing. They look at the data, they get to know the players, and in most of the markets in which they invest, they have a lot of experience now. That's what marks a quality investment. Now, they also happen to be very honest, and they're very open about disclosing the pros and the cons of investment. They keep their investors informed about how the investments are performing, all those kinds of things. So that's what marks, on the real estate side of things at least, a quality investment. It's quality investments are not just the quality of the investment itself, like the quality of a building in a real estate investment. It's the quality of the people, how they handle their business, how they handle working with their investors. All of that matters, right? And uh, this is one of, I think, the keystones to know if you're dealing with quality investments, and that is if you're getting pressed to make a decision by someone that you don't already have a with whom you don't already have a well established relationship. Sorry, I'm getting I'm getting a little tongue tied here. Then that may be a sign that you're not dealing with a quality investment. Okay. If you've been working with someone for years and years and years, and they call you up and they say, "Hey, I've got something here. I think it's really fantastic. Uh, you know, there's a short window in which to get involved." There are cases like that where legitimately there's a short window to get involved. The promoter of the investment may have set it up that way on purpose because they want to create kind of some some hype to get it closed as quickly as possible. But presume if you know the source well, you have a lot of confidence in the source. So then, being told this requires a quick decision can very well be legitimate. By the way, uh, there have been times in my real estate career when I've told people, look, this requires a quick decision. So I'm not going to press you to make a decision, but just so you know, the investment is probably going to be available until the end of this month or whatever. And if you decide you want in, you probably want to make a decision by then. Otherwise, you may risk not having the opportunity to invest. I tend not to say the words miss out. That's too salesy for me. But there's never. I mean, this sort of hard sell. I find that to be. Why am I being if it's so great, so self-evidently great, why do they really need to pressure me? That's kind of how I look at it. So focus on quality investments, quality people, investments with stable earnings, strong balance sheets, consistent dividends or consistent payouts. Look at all of those together. And again, do not miss or absolutely look at the people involved as well. Okay. So the people are part of determining the quality of a particular investment, especially if it's something like real estate or some sort of non stock market or bond market investment. The quality of the people involved really makes a difference. Okay. So those are the things to do. I'm going to mention just a few things not to do. Okay, because those can be equally important. So during volatile markets, first of all, don't panic sell. Okay. Just as I mentioned earlier, just because, let's say, a stock takes a steep drop in price, that doesn't mean you need to sell. It doesn't mean the company's going out of business. I mean, it might. Okay, the company may have announced bankruptcy on that day, and you see a big drop in the stock. But is it a liquidation bankruptcy? Is it or is it a Chapter 11, which is a reorganization? What are the prospects? I would, minimally, if I found out I was invested in a stock and the company announced that it was going bankrupt, the first thing I would do would be to look into what is the nature of the bankruptcy, because some companies will go into bankruptcy in order to reorganize, get rid of unprofitable locations, be able to cancel leases on space that they no longer need. And they're actually going to come out of a Chapter 11 stronger than when they went in. So to sell at that time may not make any sense, even though the stock drops in value on the announcement of the bankruptcy. So don't panic sell. Sometimes, maybe, in some cases, maybe in more than some cases, locking in losses can be worse than just weathering the storm. So understand what's going on with an investment that's lost a lot of value before making a decision. Number two, and I've talked about this already, don't try to time the market. Okay. It's largely a fool's game. That's why I talked about dollar cost averaging. That's a much better way to make sure that that overall you're building a sound portfolio of investments. But again, timing the markets, almost for sure, you're not going to do it well. Okay, next, don't follow trends blindly. So, for example, meme stocks. They can be fun, and maybe you're kind of into that, and that's fine. But I wouldn't build a portfolio on meme stocks, or attempt to build a portfolio on meme stocks. Maybe you allocate 5% or even 10% of your investment dollars to playing in meme stocks because it's fun, you enjoy it, you interact with your friends, whatever that is. Okay, but in terms of trends, like crypto was a big trend for a while. Now it's becoming more of just a standard asset class. I know. I had a friend. He's still a friend. He got really excited about some cryptocurrencies a while back, and he's like, "Oh, you got to buy these." And I was like, "No, no, no, it's like the latest. It's going to be the next Bitcoin." No, probably not. Probably not. It takes Bitcoin is a phenomenon. It was an early. One of the earliest cryptocurrencies. If somebody's telling me that a certain cryptocurrency is going to be the next Bitcoin, no, probably not. Okay, so again, if the herd is going one way, oftentimes the smart money is betting against the herd, right? So don't blindly follow trends. Really look into them. Is this really a good investment to make? This meme stock or this cryptocurrency, or whatever it is that everybody seems to be jumping on the bandwagon and investing in it. Okay, and finally, don't put your money in one hot sector. Okay, that's why I talked about diversification, diversify wisely, and focus on quality. So quality is important, but you still have to diversify as well. So you can have quality in a single sector, and for whatever, like luxury goods, right? If luxury goods have done very, very well up until just recently, and so if you were invested solely in luxury goods stocks, you probably did pretty well. But all of a sudden now, they've turned. And so to be invested in only one sector, even a hot sector, means that you're essentially forced to try and time the market. And that's, as I've already mentioned several times, almost impossible. So, if you think that a particular sector is hot, you may allocate some additional funds to it, but I wouldn't put all of my funds in, one sector. Stay diversified. That's the best thing for the long term. Okay, so look, some final thoughts. Uh, generally speaking, during volatile times, the best thing is to stay the course. If you have a well diversified, high quality group of investments, while they may fluctuate day by day or week by week or whatever, it's nothing for you to worry about. That's just part of the volatile times we're in. But you're probably best off staying the course. You like I said, you I would recommend you kind of go through this list and say, do I need to reassess my risk tolerance? Am I sufficiently diversified? Ask yourself kind of these five questions, and see if there's any deficiencies on those bases, rather than something emotional. So the main and I'm gonna close with this, and that is, if you don't have an investment plan, now is the time. Well, the best time to have an investment plan was when you started investing, but if you don't have one still, now is the time to put one together. Having an investment plan helps us respond properly when times are volatile, right? Because it's something that we've put together, we've thought it through, we've worked it for a while, and we've been able to hopefully work out some of the kinks. That's what we want to do, and we want to have that plan available to us when it gets tougher to be making decisions. So, you know, again, if you don't have an investment plan, this now is the time to develop it, and I would focus on that rather than doing things like trying to time the market and all the frankly ill-advised situations that people get themselves into. Okay, so if you have any questions, comments, criticisms, thoughts, all the links to my social media will be in the show notes after this episode posts on YouTube. I welcome them. If you have something of a private nature, my email address will be there as well. I do not give individual investment advice. This was all just meant to be educational. So, if you want a referral to an investment advisor or a wealth advisor, that I'm happy to help you with. But I'm not going to be advising you on your individual situations. So let's see. Okay, for tomorrow, Thursday at 5 p.m. Pacific time is my every other week show, Jiggers' Place. We're going to sit back, have some grog, the Navy cocktail, I guess we could call it. And we're going to talk about duty. What is duty? Why should we be concerned about what is our duty? And to whom do we have a duty? To ourselves, our family, our friends, our community, our country, the world, to God. These are the questions that we're going to talk about over some grog. So I hope you'll join me again tomorrow, Thursday at 5 p.m. Pacific time. And then next week on Monday at 10 a.m. Pacific time is my show, Trusts and Estates Weekly. My guest is Andrew Nutbrown. Andrew is going to be talking about cross-border estate issues. I think that you will find this particularly interesting. I haven't addressed this issue on my shows I think ever, but certainly not in the depth that Andrew to which Andrew is going to go. So please join us for that. On Tuesday at 10 a.m. is my show, Business Lessons from the Military, and then we'll be back 1 week from today with the next edition of People Making Money. So thanks again for watching, my live viewers especially, and wishing you all a wonderful rest of the day, and signing off as I always do. Marie, darling, you are my bell. Courage at all times.